Let's keep the conversation rolling with our next guest, who says and warns, we've all heard the line, bad news is good news. It keeps the Fed on the sidelines, so forth and so on. He says, no, bad news is bad news, no matter how the markets have been reacting lately. Let's bring in Chris Senyek, Chief Investment Strategist with Wolfe Research. It's great to see you, Chris, and explain what you're trying to say here.
Yeah. Hi, Kelly. Thanks for having me. So, we're in this phase where, whether the Fed hikes 0 or 1 or 2 more times, I don't think is really the story here. It's about how quickly will the economy slow, and in fact, how will stock sectors react to bad news, right? And we've all talked about, Mike talked earlier about the consumer slowing and the sentiment, and so we think that the bad news will in fact be perceived as bad news. You don't have the Fed liquidity driving stocks, and the lagged effect of Fed rate hikes is just starting to show up. We've looked historically, and it takes about 18 to 24 months for the impact of Fed rate hikes to hit the consumer and spending. And if you think a year ago, the Fed funds rate was still, before this next Fed meeting, at only 2.5%, right? So it just takes time. And I think we got a little ahead of the gun thinking that it was going to show up in the first half. And in reality, I think it's going to show up here in the second half.
And what does that mean? So the obvious implications to that, if it sounds like it's worsening, are lower stock prices, maybe lower bond yields, kind of the whole thesis that I bet a lot of people in our audience don't want to hear right now.
Well, I think what the market's struggling in the near term is rates and oil, right? And higher oil prices push up interest rates, on the long end, and it creates a little bit of problem for the Fed, right? Sort of the quickest thing we've argued that can end the disinflation narrative is higher oil prices, something in which many of which, including the Fed, can't predict. And then secondly, sort of almost idiosyncratically, what the Bank of Japan is doing and letting their long-term interest rates back up and relaxing yield curve control is pushing up longer-term interest rates. So I think as U.S. long-term interest rates move up over the next few months here, that itself is going to slow the economy. And I think ultimately interest rates end below 4% on the 10-year by the end of the year as the economy really slows. And if, in fact, we do see somewhat higher interest rates, I think that starts to slow housing, which starts to slow consumer spending. And it has this, in a way, snowball effect on the economy.
I was going to ask you to talk a little bit about what you see in housing and what the effect of that is on consumer sentiment and then consumer spending, what they feel and then what they do. So why don't you do that and also address how inflation is affecting consumer sentiment and consumer spending? Because as people look at prices that are stubbornly high for groceries, for gas, for other things, they may not be spending as liberally as they had been.
Yeah, so there's a lot of news in the press about real wages becoming positive again, right? And that has happened in the past, just as you've gone into a recession. But I think what a lot of the folks miss is that there's the cumulative impact of inflation. So just because a good went from 100 to 120 and now it's only going to 125, we get excited about because that's disinflationary, but it's still 25% over the last 3 years, such that if you look at some of the surveys by U Michigan looking and asking consumers, are cars and houses affordable, the results look terrible. People are saying houses and cars aren't affordable. So if the two biggest areas of the economy aren't affordable, I just don't think that can be a good thing. I think housing prices and them being strong enough a lot over the last 3 years has really propped up the consumer, but low inventories is what's holding, prices up, right? Because in a way you have an asset which hasn't adjusted to fair value, i.e. because of higher interest rates, propped up by the fact that there's no inventories. And I worry that if you all of a sudden start to see a slowdown in the economy, start to see more job losses, you could just see a total rash of inventories enter the housing market and see a bigger than expected collapse in prices than many folks are anticipating. So we think because houses and ours aren't affordable, that's actually not a good thing. That's a bad thing. Ultimately, it's got to, in fact, hit end demand down the road.